Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So if you've been keeping even half an eye on the financial news lately or, just scrolling through your phone, you've probably seen those headlines flashing in bold red letters. Crude oil prices suddenly just took a dive.
Yeah, really sharp dive.
Right. We saw this solid 6-day rising streak just completely snap. Like on August 13th, the global benchmark, Brent crude, fell 2.1% to roughly $87 a barrel. And the U.S. benchmark, WTI West Texas Intermediate, dropped 2.4% down to about $81.
Which is a pretty significant move for a single day.
It is. And I mean, if you were sitting at home planning a cross-country road trip or just looking at your monthly budget, that sounds like a massive win, right? It sounds like inflation is finally cooling off, the economy is stabilizing, and your wallet is about to get a well-deserved break.
It definitely feels that way on the surface. That initial headline drop gives a real sense of relief. It feels like, well, gravity is finally pulling costs back down to earth.
Yeah, exactly. But as we often find when we peel back the layers of the economy, things are rarely that simple.
Oh, for sure. Looking at the underlying market mechanics, that surface-level price drop is actually masking a highly complex and, frankly, much more concerning reality.
Which is wild to think about.
Right. We are basically looking at a situation right now where the top-level numbers and the physical reality of the market are telling two entirely different stories.
And bridging that gap is basically our mission for this deep dive. We are focusing on one massive, widely misunderstood theme today,
Okay.
which is why falling crude oil prices are currently creating an illusion.
A very dangerous illusion for investors.
Absolutely. We are going to explore why a drop in the price of raw crude absolutely does not mean your gas at the local pump or your upcoming plane tickets or even just everyday manufactured goods will get cheaper anytime soon.
Which is the assumption everyone makes.
Right. So to do this, we've gathered a stack of recent commodities reports, International Energy Agency data sheets, and maritime shipping logs. Based on this recent analysis, we're going to decode the critical difference between the raw material and the finished product.
And most importantly, what this strange dynamic means for your investments. Because if you're trading or, budgeting based purely on those top-level headlines, you might be walking directly into a trap.
Okay, so let's get into it. How exactly did this trap get set?
Well, it is a really common trap, especially when the initial data looks incredibly convincing. To truly understand the current market, we first need to look at the exact numbers that spooked investors and caused this recent August 13th price drop.
Okay, lay it on me.
According to the analysis, three specific triggers basically hit the market all at once. First, the International Energy Agency, or IEA, cut its 2026 global demand forecast by 1.6 million barrels per day.
Okay, so a drop in expected demand.
Got it. Right. Second, OPEC stepped in and lowered its own demand forecast as well. And third, and this was the real shocker, for Wall Street U.S. commercial crude inventories surged by a staggering 17.4 million barrels in a single week.
Wait, 17.4 million barrels in just 1 week.
Yep.
For anyone trying to visualize that, a standard barrel holds 42 gallons of crude. So
Yeah.
we are talking about hundreds of millions of gallons of oil just suddenly appearing on the U.S. balance sheet.
Exactly. It's the biggest single-week jump we have tracked since January of 2023. And when commodity traders see a massive number like that flash across their terminals, their immediate algorithmic reaction is just to sell.
Sell everything.
Pretty much. The standard logic dictates that if demand forecasts are falling and physical supply is suddenly piling up in storage tanks, well, the price has to go down.
Let me try to unpack this with a visual for you listening at home.
Yeah.
Think about it like a coffee supply chain.
Okay, I like coffee.
Right. Imagine a massive warehouse down by the commercial docks, and it suddenly gets flooded with tons and tons of unroasted raw coffee beans. Naturally, because there's this sudden glut of raw beans sitting there, the market price of unroasted coffee drops.
Makes perfect sense.
That's essentially what just happened with U.S. crude. We got a massive, unexpected delivery of raw material. But I'm looking at this data, and I really need you to help me make sense of it.
Okay, what's the issue?
If we have this massive 17.4 million barrel surplus of our beans, why do these same reports simultaneously state that the global oil market is actually incredibly tight and undersupplied right now? How can both be true?
Right, that's the core contradiction. The key is understanding that one localized data point can completely distort the global picture if you don't look at the historical context.
So the 17.4 million is out of context.
Exactly. Focusing only on that massive U.S. inventory jump is where the illusion begins. Yes, 17.4 million barrels is a historic number for a single week, but it was primarily driven by a temporary spike in imports arriving all at once.
Oh, so it wasn't a sudden boom in our domestic production?
Not at all. It's just a scheduling pileup. More importantly, even after absorbing that historic one-week delivery, total U.S. commercial crude inventories are still running about 2% below their 5-year average for this specific time of year.
Wait, let me make sure I'm hearing that correctly. Even after dumping 17.4 million extra barrels into our commercial reserves, we are still below the historical average.
Yeah,
We haven't even caught up to normal levels.
that is exactly what the historical data shows. The inventory jump provided a very strong short-term signal for day traders to take their profits, which is what pushed the price down on August 13th.
Okay, I see.
But it absolutely does not mean the United States, let alone the world, is suddenly swimming in excess oil. In fact, if we look beyond U.S. borders, the macroeconomic situation is moving in the exact opposite direction.
Which brings us to the real issue. If the U.S. isn't overflowing with oil, where's the global supply actually choking? Because to understand the price of any global commodity, you really have to find the bottleneck.
And we definitely have a massive bottleneck right now.
Yeah, according to the maritime logs and reports we are looking at, we have to turn our attention to the world's most critical energy transit route.
Right. See, while the financial media was highly focused on the IEA lowering its demand forecast by 1.6 million barrels a day, they largely glossed over the other side of the ledger.
The supply side.
Exactly. The IEA actually lowered its supply forecast far more dramatically. They are now projecting global supply to be down by 4.3 million barrels per day compared to last year.
Wow, down by 4.3 million.
Yeah, so because of this steep drop, the actual market shortage for the third quarter is estimated at a massive 1.8 million barrels per day. The world is running at a severe deficit.
So the demand for oil is dropping, sure, but the available supply of oil is dropping almost 3 times as fast.
Precisely.
And reading through these geographic reports, a huge reason for that supply drop isn't that the oil just vanished from the ground, right? It's that we literally cannot physically move it to where it needs to go.
The logistics are severely compromised. The Strait of Hormuz, which borders the Middle East, is effectively acting as a closed bottleneck right now due to the ongoing geopolitical conflicts.
Just totally jammed up.
Yeah. Historically, we're used to seeing total Gulf region exports hovering around 20 million barrels per day. Right now, that number has plummeted down to around 12 million.
That is a massive drop.
We are talking about 8 million barrels of oil a day, essentially trapped, delayed, or just forced to find incredibly inefficient, highly expensive alternative routes around the Horn of Africa.
And here's where it gets really interesting for me, because you would think in the modern era of constant satellite tracking, digital logistics, and GPS, we would at least know exactly how much oil is making it through that bottleneck.
You would think so.
But we don't. The data discrepancy here is wild. Recent analysis highlights that U.S. Energy Secretary Chris Wright, operating under the current Trump administration, he claims that about 9 million barrels per day are successfully flowing through Hormuz.
Right, the official government estimate.
But if you look at private, independent maritime data trackers like Quappler and LSEG, they estimate the flow is much, much lower. They're tracking anywhere from just 1.7 million to 6.9 million barrels per day.
Which is a huge spread.
It's insane. How is it even physically possible for the government and private satellites to look at the exact same body of water and be off by millions of barrels a day?
Well, it comes down to the methods used to track what the industry calls the dark fleet.
The dark fleet.
Yeah. When oil tankers enter high-risk conflict zones, many of them turn off their automatic identification system, or AIS transponders, to avoid being targeted.
Oh, they go totally dark. That makes sense.
Right. So private trackers often rely on highly sensitive satellite imagery, checking ship drafts to see how heavy they are, and real-time port arrivals to estimate the volume, which can be really difficult when ships are actively hiding.
Right. And what about the government numbers?
Government agencies, on the other hand, might be relying on slightly older geopolitical models, different reporting timelines, or official export declarations that just don't always match the physical reality on the water. A difference of several million barrels a day is enough to completely alter global economic models.
This is exactly like trying to plan that massive family road trip we talked about earlier. The government highway authority is telling you, don't worry, all 4 lanes of the interstate are open. You'll make great time.
Right.
But then you turn on the local news, and the private traffic helicopters reporting that 3 lanes are blocked by a pileup, and only one lane is actually squeezing cars through.
That is a perfect analogy.
So as an investor, how could you possibly price a barrel of oil accurately when top authorities and private trackers are millions of barrels apart on what is actually floating on the water?
You really can't with absolute certainty. And because of this massive gap in data, the market is forced to price in what economists call an information uncertainty premium.
Information uncertainty premium.
Right. When algorithms or human traders buy a barrel of oil today, they aren't just paying for the physical liquid and the operational cost to extract it. They are paying a premium for the anxiety of the unknown.
Wow, paying for anxiety.
Exactly. They are factoring in the risk that no one definitively knows the true volume making it through the Middle East. If those private trackers are correct and the flow is closer to 2 million barrels a day, the physical market is profoundly tighter than the official government estimates suggest.
And because that supply is choked and insurance premiums for these ships are skyrocketing, the final cost of getting oil out of the Middle East got so high that it triggered a really bizarre economic phenomenon.
Let's talk about the demand side now.
So let's do it.
Because the top-level headline said demand is falling, which sounds like a standard economic recession. But diving into these reports, the data shows it is something entirely different.
It really is. If we look closely at the underlying mechanisms, the lower demand forecast we mentioned earlier, that 1.6 million barrels per day drop for 2026 is not happening because of a normal economic cycle. So it's not a normal recession.
No, it is not your standard run-of-the-mill recession where consumers simply tighten their belts, drive a little less, and save their money. It is a specific industrial phenomenon known as demand destruction.
Demand destruction. That sounds intense. What does that actually look like in the real world?
It means the high oil prices and the soaring shipping costs associated with avoiding these conflict zones are literally forcing businesses to shut down operations just to survive.
Really, shut down completely.
Yeah. The economic activity isn't fading naturally. It is being actively crushed by the supply shock itself.
Oh, wow.
For example, a petrochemical plant in Europe or Asia might look at the cost of importing raw crude to make plastics and realize that the energy required to run their machines is now more expensive than what they can actually sell the final plastic for.
So they just lose money if they stay open.
Exactly. So they reduce their operating hours or idle the plant completely. Airlines might cancel marginal cargo routes, global supply chains slow down simply because the fuel required to run them destroys any potential profit margin.
Okay, let me make sure I'm translating this right for you listening. It's not that people don't want to drive to work or that factories don't want to manufacture goods.
Right.
The underlying desire and need for the economy to run is absolutely still there. It's that the raw material required to do those things is so outrageously expensive that it's literally forcing the factory to turn off the lights.
That's exactly it.
The input cost of doing business has just exceeded the revenue benefit. So dropping demand in this specific scenario isn't a sign of a lazy economy. It's actually proof of how severe the supply crisis is. Have I got that right?
You have the mechanics perfectly, and this raises an incredibly important question for anyone managing an investment portfolio. How do you react to this?
Yeah, how do you trade this?
Because this is why we cannot treat this like a typical textbook recession. In a normal recession, consumer demand falls off first, and then the leftover oil supply slowly piles up in storage tanks, which pushes prices down naturally until the economy recovers.
Right, the usual cycle.
But right now, we are in a uniquely dangerous dynamic. Demand is falling artificially because of high prices, but the actual physical supply is falling even faster due to geopolitical bottlenecks. We are simultaneously experiencing a forced demand crisis and a severe physical supply shortage.
Which brings us to perhaps the most crucial insight of this entire deep dive, especially for your wallet and your understanding of inflation. This is the big question everyone asks, right?
The gas pump question.
Exactly. If the price of crude oil drops on the stock ticker, why doesn't my gasoline at the local station get cheaper immediately? Why are plane tickets still so expensive? We have to talk about the great disconnect between crude and refined products.
This is where we have to firmly separate the raw material from the finished product. We talked about that 17.4 million barrel surge in U.S. crude inventory.
The unroasted coffee beans.
Right? But if you dig just a few lines deeper into the exact same government report, you find a startling divergence. While raw crude inventory went up, U.S. gasoline inventory actually went down by 1 million barrels in that same week.
Wow, went down.
Yes. Gasoline inventory is currently sitting at 6% below its 5-year average. And it's even worse for what the industry calls middle distillates, which are the heavy-duty workhorse fuels like diesel fuel, jet fuel, and heating oil.
How bad are those?
Those are currently running 12% below their historical average.
So we basically have a mountain of raw, unrefined crude sitting in storage in places like Cushing, Oklahoma, but a very real shortage of the actual usable fuel we need to put in our cars, trucks, and airplanes.
And it is a global shortage. Maritime exports of diesel and jet fuel are down significantly across the board.
Really? Like how much?
For example, maritime exports of jet fuel from key global producing regions are down by 670,000 barrels a day compared to this time last year.
That's massive.
It is. And because these finished, refined products are so incredibly scarce, the profit margins for the companies that make them have just skyrocketed.
Okay, I think I know where you're going with this.
In the energy industry, this refining margin is called a crack spread. It's the difference between the cost of a barrel of raw crude and the price they can sell the refined products for. Those crack spreads hit record highs in the Atlantic region in July.
Let's bring back our everyday analogy, but let's evolve it from coffee to baking. Think about raw crude oil as flour. Gasoline, diesel, and jet fuel are the baked loaves of bread.
Okay, flour and bread.
We might have a massive surplus of raw flour sitting in a warehouse in Texas. But if the bakeries, which represent the oil refineries, are struggling to process that flour fast enough, or if the delivery trucks can't get the bread to the grocery store because of logistical shipping nightmares, well, the price of a loaf of bread stays sky high.
That's exactly what's happening.
The upstream producers pulling the flour out of the ground and the downstream refiners baking the bread, they're operating in two entirely different economic worlds right now.
That analogy illustrates the exact mechanical disconnect happening today perfectly. And here is why this matters directly to the average consumer and to the global economy. Central banks, like the Federal Reserve, and everyday consumers measuring their household budgets, they only care about the price of the bread.
Right. Nobody is buying raw crude at the supermarket.
Exactly. When inflation is measured, the government is looking at the price of pump gasoline, the cost of airline jet fuel, and the diesel that powers the commercial trucking industry. They do not care about the spot price of a raw barrel of Brent crude.
So the headline drop is meaningless for inflation.
Basically, yes. Even if headline crude prices drop 10% on your TV screen, energy inflation is going to stay stubbornly high for you if those refined finished products remain scarce.
So what does this all mean for your portfolio? How does a smart investor actually use this information? Because it sounds like you can't rely on the old Wall Street rules of thumb anymore.
You really can't.
Usually I look at my portfolio on a day like August 13th and think, okay, crude oil is down 2%, it is time to buy airline stocks. The old logic is always lower oil prices mean cheaper fuel for airlines, which means higher profit margins for them.
Following that old playbook today is a massive risk. The most critical takeaway for investors is understanding that oil is not a single monolithic asset class anymore. You have to separate the upstream companies from the downstream companies.
The producers versus the refiners.
Exactly. Upstream producers, the ones pulling crude out of the ground, they are facing price drops on their raw material and logistical nightmares trying to export it. But downstream refiners, the bakers in your analogy, they are seeing incredible profit margins because that crack spread is at record highs.
Oh, because they buy the cheap flour and sell the expensive bread.
Exactly. They're buying the raw material relatively cheaper and selling the finished product at a massive premium.
So if I buy an airline stock just because crude oil dropped, I'm flying completely blind.
No pun intended.
Right, because an airline doesn't put raw crude into a Boeing 737, they run on jet fuel.
Yeah.
And because the crack spread for jet fuel is so high due to refinery bottlenecks and export drops, the airline's actual operating costs might still be through the roof.
The data backs that up entirely. An airline's operating cost is tied to the jet fuel crack spread, not the Brent crude headline. And the exact same logic applies to chemical and petrochemical companies.
Wait, how so?
Well, novice investors often think falling crude means cheaper raw materials for making consumer plastics. But as we discussed with demand destruction, if the overall global industrial demand for finished plastic goods is dropping even faster than the raw material cost because factories are idling, well, those chemical companies are not going to see a financial win.
So they don't benefit from the cheap crude either.
No, the profit margins will actually compress, not expand.
That completely flips the script on how to look at the energy sector. So
Yeah.
where is the power in this market? If the old rules are out, what specific traits should investors be looking for in these companies?
In this specific, highly fractured environment, the companies that hold the real leverage are the ones with strong, sophisticated refining capacity and critically safe alternative export routes.
Alternative routes, like avoiding Hormuz completely.
Yes. For example, producers in the Middle East who have proactively developed infrastructure to completely bypass the Strait of Hormuz, using overland pipelines to alternative ports, or ship-to-ship transfers outside the conflict zone, they are the ones capturing the real value.
Because they avoid the bottleneck.
Exactly. They can actually get their finished product to the global market safely without paying those exorbitant insurance premiums. As an investor, you must separate the headline crude price on the ticker from the physical, logistical reality of the refined products market.
It really is a tale of two markets. You have the paper market on Wall Street, where algorithms are panic selling over a 17 million barrel inventory jump.
Right.
And you have the physical market in the real world, where factories are literally shutting down because they can't afford the diesel to run their generators.
It is a remarkable disconnect, and it highlights why reading past the headline and understanding the physical logistics is so essential for protecting your investments.
It really is. To wrap up, we want to leave you with a final mind-bending fact from these reports that we haven't even fully touched on yet.
This is a crazy one.
It really is. While the market was busy reacting to that one-week jump in U.S. crude inventory, there is a much larger silent drain happening globally. According to the data, since the current geopolitical conflicts began, global observable oil inventories have drained by an astonishing 410 million barrels.
To put that in perspective, 410 million barrels removed from the global system represents a massive loss of the market's historical safety cushion. We are effectively operating without a net right now.
No backup supply?
None. Any sudden weather event or further geopolitical escalation hits the market with zero buffer.
Exactly. We are flying without a net. But here is the flip side, the ultimate wild card for your portfolio. The International Energy Agency notes that if, and this is a massive if, a peace treaty is reached and Middle East production normalizes, we could see a sudden rapid influx of 8.3 million barrels a day flood the market by 2027.
Which would change everything.
Right. The current oil price isn't just a reflection of daily supply and demand. It's effectively a massive high-stakes options market betting on the probability of a peace agreement.
It is the ultimate binary event for the global energy markets. If that bottleneck clears overnight, the demand destruction we are seeing now will suddenly be met with an absolute tsunami of supply.
What happens to your portfolio if today's historic shortage turns into tomorrow's overnight flood? Something to chew on as you review your investments this week. Don't forget to subscribe and hit that like button.